If you're trading and losing, you probably need to improve your risk management. Risk management is probably the biggest factor that comes into play when new traders blow accounts or lose large amounts of money. Rule number one with risk management is use a stop loss. I see way too many people online now not using stop loss, and some saying they're actually against having a stop loss in place. A stop loss is there to protect you. It's not against you. It's there to work in your favor. Sometimes if we are wrong on a trade, we are wrong and we must accept being wrong. It's part of the parcel. If you have a system that you've back tested and you've got tons and tons of data to work out perhaps it is a successful one, you'll notice you won't be winning 10 out of 10 trades. Personally, me as an intraday day trader, I work to about a 7 or 8 winning trade out of 10 success rate, meaning before I start trading, I'm immediately putting my hands in the air and saying I'm willing to lose 2 or 3 trades out of 10. That's going to help you understand some realistic expectations, but also remove your emotions when trading. So first thing, Monday morning, you have a losing trade, but it was by your rules. It's just one of those things. So be it. It simply means you're closer to your next winning trade. It's not cool to trade without a stop loss. Just because perhaps you want to wait for the market to swing back round and get you in front, that could take months, sometimes years. Have a stop loss in place that fits in with your strategy criteria. Personally, I use around a 20 to 25 point stop loss on an hourly time frame. That takes into consideration the average hourly bar size, the positioning of where I am in the chart, and a few other key factors that I use when trading. So at least I know I've got an average amount that I'm willing to risk per trade, and I'm comfortable with that. I know having those parameters in place allows me to win a lot more trades than I lose. So rule number one, place a stop loss. Have a stop loss in place when you are taking a trade that fits in with your parameter that's going to keep you safe. You will not blow your account if you have a risk managed portion, so your lot size is correct, and a stop loss in place to protect you when you are wrong. Sometimes we are wrong, and let's accept it. On the flip side of that, you need to have a rule implemented that when you're X amount of pips up, or when you're 0.5% in front, or when the market breaks a recent high, some sort of rule in place that's going to give you the heads up to bring your stop loss to break even. When you bring your stop loss that was risking, say, 1% of your trading account into the same point that you entered, you now have a risk-free trade. Therefore, you cannot lose. And again, to talk about my style of trading, it's a 1 hourly bar that has to close. If an hourly candle closes 25 pips above my entry, the reason why I wait for the close is so that pip amount, say 25 pips, is confirmed. When the bar closes, it's not going to change color, size, appearance, whatever. It's closed bar, and you can confirm on that hour you was 25 pips up. Therefore, that allows me to bring my stop loss that was risking 1% of my initial count balance into the same point I entered, so it's break even. Let's say something crazy happens or I miss a bit of news and I get stopped out. No problem. I'm stopped out at the same point I entered. Therefore, my balance or my P&L on that individual trade would be 0. The plan then is to work in percentage value. If you gain another couple of percent, your stop loss goes into a couple of percent worth of profit. So as the market rises, you're trailing your stop manually, not an auto trail. I believe you get stopped out way too quickly with an auto trail. You're manually raising your stop loss in a set requirement to ensure you're banking in profit or locking in profit as the market pushes forward. So that's key. Have a rule in place to bring your stop loss to break even, to become risk-free so you cannot lose. That will, again, remove your emotions from trading, allowing you to focus on price action and taking the most out of the market. If you're at more of an intermediate advanced level, when you place perhaps a trade early in a higher time frame trend, so at the beginning of a move with tons of upside potential and reward, you then need to think about a method called scaling in. So as the market cycles, let's say on average we can see around 4 to 6 cycles in a trend. If you're entering at cycle 1, you know you've got another 4 cycles that the market's going to move to get from your support to resistance or from your bottom to top. When you start to understand cyclicity and you find additional entry points as that trend progresses, providing your first trade is break even, so you have 0 risk, you're going to fancy yourself placing that 1% you was initially risking on your first trade, which is now risk-free, on your second trade. And perhaps by the time you get to your third trade, your first trade might have locked in 2 or 3%, your second trade might have locked in 1 or 2%, so you could be 5% growth over 2 trades, and look to take a third, so in essence have 3 running live trades. Now, any future trade risk is only going to be taken out of the profit you've already banked from trade 1 or trade 2. So you're using money on the table to risk on future trades. That's a method called scaling in. It's a great forward risk management tool to ensure you're making the most out of the market. And something else to think about as well is your lot size. Now, we use an app called Stinu, that's S-T-I-N-U. It used to be free, but I think we've promoted it way too much. I think it's about 11 quid for the year or something now. It's a fantastic tool that you can use to give you the correct lot size. We've got to remember, and I see so much online about people trading at one lot, meaning $10. How lot size works is it's worked out on the quote currency. So if you're trading one lot on Euro USD, you will be trading 10, so it's 10 standard units of the quote currency. So you'll be trading 10 US dollars per pip. If you're trading Euro GBP, you'll be trading 10 British pounds. So again, one lot trade on Euro dollar long, one lot trade on Euro pound long are going to be 2 completely different lot sizes. Now, it's okay when you're working in currency that you understand and you're aware of, but when you're looking to convert Kiwi dollars or Japanese yen quite quickly when the market's moving, it's not a simple process. So having a lot size calculator is going to save you time and money and ensure you're trading the exact lot size. Again, if you are trading the exact lot size, which should be 1% of your account balance, so a predetermined percentage, divided by the distance in pips from your entry to your stop loss, that's going to give you the amount you're trading at per pip. When you are trading correct, and let's say for the day you have 1 winning trade, 1 losing trade, at least your balance, your P&L for that day is going to be 0. Too many new traders might win 3, 4, 5 trades, and then 1 unlucky trade wipes out all your profit for that day or that week. That's poor risk management. So guys, if you are new to the financial markets and you are perhaps beginner to intermediate stages, you need to spend way more time learning the key fundamentals of risk management. Protect yourself. As I always say to my community and my team, we are risk managers, we are not risk takers. So preservation of capital is rule number 1. If we have no money in our trading pot, we can't make money. A builder can't rock up and build a house without any tools. Our money is our toolkit to get the job done. So guys, if you are serious about trading, get in touch. We've got a full team of traders here who can hold your hand through the process and get your risk management where it should be. Speak soon, guys.